Welcome to CSI Chat, where every topic's fair game. From finance to mysteries, we'll never be the same. Our host an accountant with a knack for a joke. We'll dive into the details and laugh until we choke. CSI Chat, where the numbers beat the fun. We'll explore every subject under the sun.
Okay, well, we are very lucky today to be joined by two prominent accounting professors, Professor Feng and Professor Baruch Lev. Thanks very much for joining us today, guys. I'm going to give a little bit of a brief background on both of you. So I'll start with Professor Feng. He is a chair and professor of accounting and law at the University of Buffalo. His research focuses on measurement and valuation of intellectual capital, corporate management, and reporting of investments and intangibles, and firms' voluntary disclosure of financial and non-financial information. He is also the co-author of two really good books that I've read. I've read both of them, and I would highly recommend people who have an interest in finance definitely take a read of. The first is the M&A Failure Trap, and that's what we're here to talk about most today. But the M&A Failure Trap: Why Most Mergers and Acquisitions Fail, and How the Few Succeed. And before that, there was another book that I had read. It's called The End of Accounting and the Path Forward for Investors and Managers. And his co-author on both of those books was Baruch Lev, who I'm going to introduce next. Professor Lev, he is a CPA and worked for 6 years in public accounting, served on several boards, and was a partner in a consulting firm. He is currently the Philip Barth Professor of Accounting and Finance at the New York University Stern School of Business. And he's formerly a professor of accounting and finance at the University of Chicago, Tel Aviv University, and the University of California, Berkeley. So guys, thank you very much for joining us today. We really appreciate you taking the time.
Thank you.
So
Thank you for having us.
yeah, you're very welcome. So maybe I will start with, I'll put this question over to you, Baruch, as a starting point. And what I thought would be an interesting discussion is just to talk about the process of publishing a research paper versus publishing a book. I'm sure there's a lot of thought that goes into each one of those in terms of what the proper path forward is on a certain topic. But from your perspective, when you're thinking about putting out a paper or putting out a book, what's the thought process beyond, in terms of looking at each one of those two alternatives?
Journal papers are usually aimed at addressing a very specific, usually narrow question, like, for example, in the case of mergers and acquisitions, what's the best means of payment for mergers and acquisitions? Cash, equity, combination, or how do investors react when companies write off goodwill from acquisitions? So papers focus on a very specific issue, usually get very deep into it, and are published, the best of them are published in academic journals. If you want to cover a very broad issue, like we wanted to do with mergers and acquisitions, really the entire spectrum of the interesting issues of mergers and acquisitions, not just means of payments, not just investor reaction, but integration and conglomerate mergers and other things. If you want to cover a broad issue, you go for a book. A book allows you basically to extend it as much as you want. There's also a big difference in the audience. Journal papers are generally aimed at academics, and they usually use heavy statistics and mathematics, which others abhor. And they are aimed at PhD students, graduate students. Books are more aimed at the general public, at executives, at investors. at policymakers sometimes. So the differences are in the focus, in the audience, and for our purposes, we wanted to go to a very general audience, not necessarily academics. We wanted the book to inform managers, executives. We wanted the book to inform investors, boards of directors, which play a major role in the case of mergers and acquisitions. So that's why we chose to write the book.
Got it. Does
Yeah.
and in terms of standards of quality, does a research paper have a higher bar than than a book per se, or would both of them have the same level of requirements in terms of standard of quality?
Good books, like I would like to think our book is, good books have as high a standard as research papers.
Got it.
We use in the book, we don't burden the reader. We don't ask him to be an expert in statistics. It's all in appendices, but we use in the book the most advanced statistical tools. We use a huge sample of 40,000 mergers and acquisitions. Every conclusion or recommendation in our book is based on very thorough statistical testing, like in research papers. Yeah.
Yeah,
Some books are more leisurely, In my experience as an executive doing mergers and acquisitions, all consultants write books about their experience. Our book is very different. Our book is based on facts.
well, that is one thing that certainly strikes, is crystal clear with the book is that there was a ton of research that went into supporting the ultimate conclusions. And, the good thing is that when you're looking at acquisitions, you have a lot of publicly available data in order to look at. And clearly, again, you guys have looked at it through numerous acquisitions. So Feng, maybe this one over to you. I'm sure there's a variety of accounting topics and, and business topics you can touch on. Why did you choose to write a book on M&A? Maybe give us a little bit of background on why on why you chose this particular topic.
Sure, very good question. So, after our first book came out, we saw a lot of impact, and we were very encouraged to think deeper about research questions that can resonate with the broad audience of practitioners. As Baruch mentioned, we as academic researchers, our mission is to, discover and disseminate knowledge to whoever can benefit, not just all our peers like other researchers or graduate students. We constantly think about how practitioners, investors, managers, and other types of business professionals can also benefit from our knowledge. So we look across all types of events, phenomena, and topics, and we decided to write a book on M&A because this is really a very important capital market phenomena and impacts a very large spectrum of stakeholders, not just the executives who are deeply involved in making these acquisitions, not just investors whose fortune go up and down with the success and failure of acquisitions. We're talking about employees, customers, their service may be disrupted, their products may not be available after two companies merge together. And finally, the society at large. It's ongoing and it has been growing. Many companies are involved. The dollar amount is huge. It's global, and it it goes up and down with the general economic cycle and the cycle of the capital market. So there's no better capital market event that we can think of that capture relatively large magnitude of economic impact across a wide spectrum of stakeholders. So that's why we decided to write a book. Although at that time we were aware that there were already other books and work on the same topic. We thought as academic researchers, especially with Baruch's experience of being a very successful long-term researcher, we believe we could come up with something unique to help people understand what is going on in this area, and then make a couple of key discoveries that have not been, apparent to everyone involved in this area.
Yeah.
Let me just add one thing
Sure.
briefly. We were perplexed, both of us, with the alarming statistics of failure of mergers and acquisitions. I mean, people who looked at it concluded that 80% of them fail, 85% of them fail. We find it's a little lower, but still alarming. So here you have a phenomena that goes on strong. Probably the largest investment corporations are making, and the failure rate is enormous. So why would they continue investing in such a thing which is almost bound to fail? And of course, what are the reasons for that? And how can you escape this failure trap? So mergers and acquisitions for us provided a very specific and challenging issues, and we thought that lots of people will be interested in that.
Absolutely. I think it's a great topic. Now, Baruch, you had mentioned that you kind of knew going into this based on your preliminary research that the conclusion would be, that a lot of M&A, or perhaps most M&A, actually ends in failure. Is there one thing that really surprised you, though? Is that once, maybe when you compare where you started yourself, when you started this research, or at least in the early days, and when you guys completely finished off the book, is there one thing that really surprised you after you had gone through the process? Perhaps maybe you had a preset conclusion at the outset that ultimately proved out to be false, or was there one particular item that, again, really shocked you? Was there something in there, again, that really surprised you once you went through all of your research on it?
I had lots of surprises. Both of us had lots of surprises, and I'm sure we'll talk about them. But with respect to the failure rate, we find about 75% failure rate in our sample of 40,000 mergers and acquisitions. We expected that the general phenomenon of the learning curve will apply also here. That managers will get better at mergers and acquisitions over time. And indeed, consultants from time to time say, true, lots of M&A fail, but managers are better. We find exactly the opposite, the reverse learning. We find an increase in the failure rate. It used to be 50, 60%. Decades ago, it went up to 60, 70s, it's 75% now, which sharpens even more the question of what's going on in this area. Not only are manager executives spending fortunes of shareholders' money on it, they are even getting worse in doing this thing.
Feng, anything you want to add to that in terms of, or anything different, when you started at the beginning compared to where you were at the end, anything that really surprised you, or anything maybe you want to add to Baruch's point there?
Yeah, a couple of other surprises. First, I agree with Baruch's summary of this increasing failure rate, which is really, really puzzling. So on top of that, we also saw a recent resurge of conglomerate mergers. So you have been around for long enough to remember the 70s and 80s when, conglomerate business organizations were really the best business model everybody was talking about. And then shortly after that, in the 90s and, this century, we have seen failure one after another. The most recent one is GE. So we thought, okay, we're done with that. At a theoretical level, empirical level, we have seen enough to conclude that conglomerate mergers really don't make any economic sense. Yet, when we took a close look at our data, we saw a huge increase in conglomerate mergers over the last 15, 20 years, especially among large tech firms. So that really gave us another surprise to, really think about what is going on, and adds to, the intrigue of this whole area of mergers acquisition.
Got it.
You want a good
Feng-
example of conglomerate mergers by technology firm, as Feng mentioned. It's the acquisition of Whole Foods by Amazon. Like
Yeah.
this is really conglomerate. Amazon is always online. Here they buy brick and mortar stores all over the United States. This is a conglomerate merger.
Let's talk about the conglomerate mergers for a minute as well, because this one, there's a lot of discussion in the book on this one, and this one certainly was one of the areas that would surprise me. Is that like again in theory, you would think perhaps a conglomerate merger would make sense because if you were an investor into a company, you might think, okay, well, if they do an acquisition outside of their regular wheelhouse, it might give you a little bit, might kind of de-risk the business a little bit, and kind of again in one market goes up, another market goes down. But you guys actually don't, you guys, the conclusions in the book is that, really if a shareholder wants to invest, it wants to de-risk, they'll just buy another company in a different industry, as opposed to the same company who wants to invest in multiple industries. Is that fair in terms of this whole, view on conglomerate acquisitions?
That's exactly as you summarized it. Lots of advantages were claimed for conglomerate mergers, but the number one advantage was risk diversification. The same way you diversify your own portfolio of stocks, spread them over industries, why not diversify your units of the company over? And as you say, this doesn't make any economic sense because at least theoretically, corporations work for their shareholders. Shareholders don't need companies to merge. If they want to hold a company in the utility and another company in the financial services, they can just buy the shares of these two companies and get exactly the risk diversification that they need. So conglomerate mergers really lacked any economic compelling reasons. And because they were extremely hard to manage. After all, executives are human beings. Most of them can hardly manage the one company they are in charge of successfully. Think about managing 8 companies in 8 different industries, 8 different technologies, 8 different markets. It's just an impossibility. So that's why all of them went down and basically disappeared.
And Fang, this one over to you. Would you say there's ever a good time to do a conglomerate type of acquisition? You take a look at, again, you could always point to at least one company who would tend to do these well. Let's take Berkshire as an example. Berkshire invests in a bunch of different industries. Obviously, it's much easier said than done. The way Warren Buffett is almost a unicorn in what he does and about how he goes about his business. But if you're a company listening to this, is there ever a time or ever a good time to do a conglomerate acquisition? Or are we saying, look, 99 times out of 100, they're just not going to work properly?
No, I don't think there is any good time to do a conglomerate merger. As Baruch summarized, the economic foundation of this whole thinking that conglomerate merger makes sense is just empty. There's no economic reasoning that can support this idea of investing in businesses across different industries. So we're both empiricists. We look at the data, and not just the general failure rate, the higher failure rate among conglomerate mergers, but more recently we have seen a string of very high-profile examples of conglomerate companies deciding to split up their businesses. I give you a couple of names here. Warner Discovery recently announced their plan to split up their business that acquired before. CVS is also in the process of planning to do it. And about 2 weeks ago, because you mentioned Berkshire Hathaway, this acquisition supported by Warren Buffett, I think it's one food company, Kraft's, acquired Heinz, or the other way around. So they also decided to split. This is not a very standard cross-industry conglomerate, but it has the flavor because they have never been the same business. So the list goes on. So it's not we see any evidence of, oh yeah, these companies did it well, and there must be a way to do it. Berkshire Hathaway follows a different business model. Their acquisition of companies from different industries, usually they don't expect them to operate together. So the
Yeah.
decision was never made at an operational level. It was more made at a financial level, like portfolio management. But in practice, most conglomerate acquisitions happen with this aim of, first of all, de-risking their overall business portfolio, and secondly, trying to create some sort of synergies across these different units from different industries. And again, it has never worked out.
Is there
Berkshire Hathaway, just a brief comment. Berkshire Hathaway is really a unique creature. I wouldn't call it a conglomerate firm. I would call it an investment company. Because Warren Buffett doesn't manage any of the company he buys. They are big holders of Wells Fargo. I'm sure that Warren Buffett never intervened in the decisions of Wells Fargo. That's basically a huge investment and a very successful investment companies in different industries. But there is no intent here of somehow merge the companies, get synergies from the companies, which is the intention of regular mergers.
And Baruch, you mentioned synergies. And synergies probably is going to go across not just conglomerate acquisitions, but I'm sure several of the acquisitions that are mentioned in your book. Is there ever, this concept of doing acquisitions for the benefit of synergies? Is there ever a time when when you can really realistically measure the benefits of these synergies? Because you mentioned conglomerate, it would be, again, Amazon acquires Whole Foods. What does one line of business have to do with the other, and how do they create synergies out of that? That's one thing. But even if Amazon were to acquire another one, maybe even in their own wheelhouse, this concept of synergies is this kind of, chasing fool's gold type of thing, is that they really don't turn out to be beneficial. If one of the primary benefits of an acquisition is going to be, synergies between company A and company B.
It's just interesting. I mean, we looked at the executive announcements of mergers and acquisitions. And the word which appears much more frequently than any other words in all these announcements are synergies. All of them are talking about there will be huge synergies. Some of them even risk giving quantitative predictions. Our return on equity will increase from 8% to 12% after the mergers, things like this. So synergies is really abused in the language of mergers and acquisitions. Sometimes they happen. I mean, there are banks who merge and close branches, save lots of money in this case. So there are real synergies, but it's always talked about, and it's more wishful thinking than really prediction of synergies.
Yeah.
Now, Feng, over to you on this one is, give us some perspective on the data. The beauty with what, you guys are researching is that the vast majority of what you're looking at is publicly available data. With regulated companies, obviously they have to file a lot of this stuff publicly. You can track share prices, pre and post acquisitions. You can track goodwill write-offs. You can track a lot of this stuff. Give us just some perspective on the data, the data set that you had, and how you tackle that. Because this isn't, again, just looking at one or two acquisitions. We're talking about looking at thousands of acquisitions over a period of, 50, 60 years.
Yeah. Good question. It's very important for readers to understand the nature of our data set, which can give them insights into the kind of conclusions and evidence we're able to get out of our data analysis. So we started this project by looking at the largest ever data set of mergers acquisition. All available transactions going back to as early as the late 70s, all the way until the time when we started our research around 2020. we look at all of them, and then we focus, of course, as you mentioned, a publicly available company as the acquirer, because these firms would have the most information available. There are lots of acquisitions involving private firms as buyers and target. Those, if the buyer is a private company, of course, most of the time we don't know much going on. We don't even know their basic financials. So we focus on publicly traded company as the acquirer. On the target side, we really don't have any restriction. The target could also be a publicly traded company, but it doesn't have to be. It can be a private company. It can be a subsidiary of any sort of business. So we look at all of them together. And then we, of course, consider, the financial data before the merger and after the merger, stock price information, everything. So at the end, after we have added all the data together and focus on everything with available data, our final sample consisted of about 40,000 acquisitions covering the last 4 decades. So we check the data to make sure these largest acquisitions that ever happened and, capture people's attention for a long time, like AOL's acquisition of Time Warner going back to like 25 years ago, the largest one, still keeping that record. We have it in the sample. So we really make sure everything is captured. There's a lot of work going on to really make sure this is the cleanest sample we can get. And most of the empirical analysis, starts with this stage, and that's exactly what we did.
Baruch, anything you want to add to the data set in terms of, how clean it was, any adjustments you had to make or anything like that associated with that is like 40,000 acquisitions. That is a ton. That's probably a lot more than anybody would have thought that had been made over the last 50 or 60 years. Anything you want to add to the data set?
Yeah, it's by far the largest data set of any research, whether it's academic research or non-academic research. I just want to add, there's not much to add. Feng summarized it perfectly. I just want to add what we do with this sample. What we do with this sample, with the help of the very advanced statistical tools, we identify the reasons for success and failure. We have a model with almost 40 variables. Each variable in this model represents a possible failure or success trigger. For example, one of the variables in the model is whether the target company is foreign or US. Turns out that buying a foreign company is much more difficult than buying a US company. The accounting is different to relocate the people, different laws and things like this. So in our model, the variable foreign or domestic turns out to have a negative effect on the ultimate result, the success of the merger. So when we talk about conclusions, all our conclusions are based on a very systematic way of drawing them from the 40,000 unit sample that we have.
Yeah.
And Feng, one of the things you guys talked about earlier, you kind of expected the conclusion of being, look, the majority of M&A is likely going to fail. Maybe your numbers are maybe actually a little bit lower than what you might have thought. But what was this concept of the fact that we are getting worse, as a group of businesses in M&A over time is a bit of a stunning, like you guys alluded to earlier, is a stunning conclusion. What was leading you down that path, and why do you think that's the case? Like, why are we getting worse at something and not better? Because presumably, again, those folks who are doing M&A recently can go back and look at some of those large transactions the same way you guys had and come up with the same conclusions. Why do you think we're getting worse at it and not better?
Very good question. So this is one of the key puzzles we were trying to solve when we were working on our data. So after we assembled our final data set, as Baruch mentioned, we look at available literature, from the academic side, the practitioner side. We thought very carefully about what potential explanations we can provide to help us understand why the failure rate is so high overall and has been increasing over time. So out of these 43, determinants or predictors Baruch just explained, we saw a couple of really strong and systematic factors at work, which we think go a long way to explain why, number one, the acquisition failure rate has been so high, and number two, more importantly, why the failure rate has been trending up over time. Number one, for example, factor here is the ever increasing size of acquisition. So this becomes very obvious when you just plot a very simple chart of, the value of the target paid by the acquirer, the deal value. So that's how some people describe it. As time goes on, even if you adjust that for the effect of inflation, you see a very clear trend that over time, companies have been making larger and larger acquisitions. It's not just driven by a very small number of outliers, really big acquisition. Even if you exclude these very strong outliers, you still get the same result. At the median, the 50% level, the trend is going up again, even after we make adjustment for inflation. So as we explain in our book, larger acquisitions are more difficult to achieve success because the integration risk is much, much higher. That's number one. Number two, since we already talked about what surprised us, I'm going to add one more surprise here to that list, which is this discovery that we didn't expect to see at all, that over time, acquiring companies have become more financially weakened. So if you measure, for example, the profitability of acquiring companies each decade, you're going to see a very clear trend after we make adjustment for industry average performance, like return on assets and so on. Acquiring companies over time have become more financially weakened, which is really not a good recipe to achieve success in this business, because number one, it shows a sign of desperation. Their financial performance is deteriorating. They're trying to, find a way out of this, and in many cases, they just decide to do a big acquisition because they believe this is going to rescue their current business model. So that's another reason. And then I can go on to explain other factors here. And another one we have noticed is the increasing premium. So as premium goes up, more and more companies are paying a larger amount of their purchase price on questionable assets like goodwill. So goodwill is really just expected synergy, not fully anchored on any real assets in most cases. And this is pretty much included in one of the papers I had with Baruch published several years ago, that the higher the amount of goodwill, the more likely a merger and acquisition is going to fail. So, of course, the increasing trend of acquiring foreign companies, as Baruch mentioned, that also contributes significantly to the growing failure rate over time.
Let me add, if I may add one point.
Yeah, go ahead.
Here, I mean, you can get worse and worse results. Because you are doing it worse. You don't know what you're doing it. You don't know how to identify good targets. You overpay for the targets. But there is another reason for results to get worse, and that's incentives. If the incentives are misaligned, we have a whole chapter in the book, which is really unique. I didn't see it in any of the research, not academic research, not others. We have a whole chapter on managers in CEO incentives in mergers and acquisitions. They usually get huge bonuses, something in the order of 20 million, 25 million for conducting an acquisition, not for conducting a successful acquisition, just for conducting an acquisition. So they get lots of money up front, and then they get every year a higher compensation because studies have shown that the size of company is the most determinant factor of the size of compensation. The argument is that large companies are more difficult to manage. So if they acquire, they get that bonus, and they also are managing now a much larger company. It may be less successful, but it's still larger, and their compensation is larger. This is a completely misaligned incentive, which will get even very smart people to do the wrong things, in this case, to make an acquisition. They make lots of money out of it.
Yeah. No, and the numbers, I could just imagine if you studied executive comp as well over the last 70 years, I'm sure it's increased at a rate that's much higher than inflation as well. I certainly don't have the data to prove that, but the numbers that are out there are just are significant. Do you think as well? Here's another question for you. I'm interested to know the reaction of the book, and maybe Baruch, I'll start with you. Have you had, since the book has now been released, have you heard from, whether it's board members or executives or anything along those lines saying, look, I read your book. I'm really surprised with the conclusion that's coming out of this, and then tried to suggest maybe some improvements or fixes. I'm just interested if you've gotten any feedback from, readers of the book on what the actual conclusions are. Because I can imagine if you're a board member who has to actually approve these acquisitions, you certainly might be quite interested in your book when your book basically says most of these acquisitions actually fail and don't actually work out. And I'm just wondering if you got some feedback from, some of the business community, which, makes people, kind of think twice before they sign off on the dotted line.
We didn't get any direct feedbacks from executives and board members. It's not surprising. I mean, they don't like our message. The message is very negative about what they have to read, and but we are inundated, really inundated by interviews, by podcasts like yours. Just a few days ago, we did another long podcast. So there is a big interest in the topic. People want to hear about it, but directly from CEOs or board members, we didn't hear.
Yeah.
That's
I agree with
shocking. Yeah.
Brooke. The negative nature of a message is definitely going to make these people willing to talk to us, because this is not what you'd like to hear. However, from the reaction from the media and the interaction we have had with people, I think there has been a lot of interest in understanding, just like what we're doing today, understanding what we have done, why we have such conclusion, the implications, and so on. Give you an example. A couple of days ago, I think last week, there was an article from SoftBank Vision Fund. So they have a long article on how to do mergers acquisition. This is supposed to serve as some sort of guidance for their portfolio companies. Vision Fund is a large VC fund. They invest in a large number of startups, and many of these startups look at M&A as a possible venue to grow their business. So SoftBank realized the importance of putting in place proper guidance to make sure these transactions are done properly. So they interviewed me, spoke to me about the book, and I gave them some high-level summary, and they integrated some of the key points from a book into their writing. This is available on their website, so supposed to be some sort of important resources for their portfolio companies when they consider M&A as part of their strategy.
Absolutely. Like, you guys aren't saying in your book, don't do M&A. That's not really what you guys are. When I read the book, that wasn't the message that I had got. Don't do M&A. It's saying if you are going to do M&A, follow this process and go through those 40 odd factors and make sure that you go through, because just because M&A fails, it's a lot of it's just relative to a purchase price. So just pay less for it. You know what I mean? Like, and then maybe it will be a success. Like, it's interesting that there's be such a negative connotation with it. That's not how I read. I read it as saying, look, if you actually take the tools and follow the process, that you're going to be able to increase your chances of success by a lot more if you actually go through this than if you don't. Like that's how I would have thought the message, how people would have received the message.
I agree with you, but I just look at publications by consultants of mergers and acquisitions.
Yeah,
They are much more positive than us. They are much more optimistic than us. They usually admit that most of them fail, but they said, as I mentioned a few minutes ago, that the rate of failure is decreasing, that managers are getting better. They have a positive message for executives. We don't have a positive message for executives. We just basically instruct them what to do to get a successful acquisition.
Yeah.
exactly. In your research as well, did you guys look at this concept of, okay, company A announces they're going to acquire company B, and all of a sudden company's A share price would increase, because again, market expectations. But it would seem like in your book that increase has kind of declined over time. Is that that pump, but at least that initial bump isn't there because maybe people are learning that these acquisitions, don't always turn out the way people had thought they were going to turn out. Is that something as well that you guys had looked at in detail in terms of what that one-time bump is or increase on the day of announcement versus like how that's kind of trended over time?
I don't think we have any systematic statistics on the initial market reaction in the book. However, during our research phase, we did spend time looking at the pattern of this initial market reaction, let's say 1 day or 3 days, centered on the actual date of the announcement. I don't remember we saw any systematic pattern like, oh, this initial market reaction has become more positive or more negative. It's just all over the place. In general, some other studies have documented, some acquisitions just trigger negative market reaction. Maybe investors don't like the fact the acquiring company is paying too much for the target. Maybe some investors don't like the fact this target has been selected. Whatever the reason, there is always a significant percentage of mergers acquisition announcement that triggers significantly negative market reaction. There are also some announcements that may trigger positive market reaction. But that's not really the whole story because the time period captured in such examination is so short, a couple of days, 3 days, 5 days, 2 weeks, and that's not long enough to tell the whole story. Having said that, we do have a variable, 43 variable model that captures this initial market reaction. I remember it actually has a negative relationship with the eventual success of the acquisition, which means even though we may see very positive market reaction initially, this does not always mean this acquisition is going to be successful, which makes sense because the initial market reaction is usually based on a limited amount of information. Okay, maybe the price, maybe the identity of the target, maybe some initial very, optimistic assessment given by the CEOs, but that's not enough, to draw any conclusion about the long-term success. That's why a study like us, which tracks the success or failure over 3 to 4 years after the acquisition, can be more conclusive.
Got it.
If you take, and there are several studies on this, if you take large samples of mergers and acquisitions and just look at investors' reaction to the acquiring company, not the target always goes up significantly because companies pay large premium. But the acquiring firm, on average, investors' reaction is negative. So somehow investors got the message that many of them fail. So the first knee-jerking reaction to an announcement of mergers is usually a negative one.
Got it. Now, Baruch, we need to spend a minute talking about integration because the lead up to the acquisition, the close of the acquisition, probably the sexy part of being involved, the diligence, going into the details, and the excitement just surrounding the closing of the acquisition can be, something that's pretty easy to get caught up in. So definitely seen as a lot of the sexy work. And then the day the acquisition closes, is then the integration starts. And the integration I'm not sure I would describe the integration as a sexy part of the work, but it's certainly a critical part of the work. You actually referred to it in your book as the Achilles heel of M&A. Give us some perspective on integration and why is it the Achilles heel of M&A?
I really got the first inkling about the importance of integration from my son-in-law, who for many years was in charge of acquisitions for a very large technology company who acquired lots of companies. And he said, Baruch, where the failure rate is focused on is in the integration. And one of the reasons he mentioned was that top management, CEO, CFO, are heavily involved in mergers, particularly in significant mergers, but they are heavily involved in the first stages of the acquisition. The announcement, we intend to acquire, and then the search, and then the roadshow, explaining to investors why this acquisition is great, and so on and so on. This is more the fun part of acquisition. You are exposed to the world, and the Wall Street Journal calls you, and the Financial Times calls you, and then comes the integration. I mean, these people have to go to the day work back of managing the company. They cannot spend years on one acquisition. And usually the stage where the integration starts is where the top managers, you leave the project and go back. And then decisions, sometimes hard decisions, closing units, firing people, things like this are made by underlings. They have to get approval for everything. It's a long process. So the absence of the top management at most integrations, and I can understand it. You cannot spend all your life on one acquisition. The absence is difficult. In the integration, you also encounter the real issues. I'm always surprised how companies can find during the integration that the target is an empty shell.
Yeah.
This was the case when Hewlett Packard acquired Autonomy, the British software company. They paid $11.5 billion for the company. The acquisition was hailed by the CEO, by two successive CEOs, as something which will continue to change the course of Hewlett Packard. Then turns out that's what they claimed, that they cheated us. They inflated the targets, they inflated revenues, they inflated earnings, they inflated everything. There was nothing there. So that's where you get all the surprises. You don't get the surprises at the first stages. You get the surprises during the integration. You go in and you find out that the engine is missing all of a sudden. It's a beautiful car, but there is no engine there. You find out that there are very serious restrictions by the government of the home country of a foreign company.
Yeah, well, you
Like-
look at, you mentioned HP, the other one that kind of played out on the front page is when Elon Musk acquired Twitter. You just look at the challenges that he had to go through and frankly, all of the staff of Twitter had to go through, laying off 80% of the staff or whatever, that is certainly not a lot of fun at all to go
Yeah.
through and complete that integration. But the guys, Elon Musk and team must have looked at that and said, look, the only way this is going to make economic sense is if we go through and actually do this. And it just again, would take a lot of, you need to be a special type of person even to go through and lay down that kind of, like, again, to complete that integration successfully would require a ton of work that is certainly not anywhere fun to do. The closing of the acquisition was probably a lot more fun of Twitter as opposed to what happened on day 2 and actually completing the integration of Twitter, or the restructure of Twitter.
Yeah. Can you imagine the surprise during the integration of Twitter that about 80% of employees are really redundant?
Yeah.
You can lay all of them off, thousands and thousands. And Twitter, or X now, goes on as usual. All these surprises come at the integration phase. People have to make quick decisions with respect to layoffs in the case of Twitter and others. And the immediate absence of top management is a great hindrance in this case of making quick decisions.
And Feng, if you were to make one change to comp plans, we talked a little bit about comp plans in order to better measure successful integrations. What would be the one change to executive comp plans that you would make in order to make sure that the integration goes successfully?
Well, this is a very important decision. Obviously, after we have seen all the evidence in our book, we would advocate this idea of waiting for extended period of time before handing out any acquisition-related bonuses to executives. Not just a couple months until the deal closes, until the initial phase of integration is done. No, we have to wait long enough, 2 years, 3 years, to see tangible, verifiable, and concrete evidence of benefits in excess of the cost of the acquisition before any bonus is handed out to executives. And also, on top of that, there got to be stronger disciplinary effect against unsuccessful acquisition. We don't see that in our book. We actually saw the opposite. For CEOs doing serial acquisitions, they got longer tenures for their contract. It's like when they're busy integrating early acquisition, they're given lots of benefits of doubt. The board always give them extra time to go through the integration, to make sure synergy is created. This also creates some kind of misincentive for executives to care more about closing a deal rather than succeeding a deal. So this part has to be addressed. Otherwise, this whole cycle is just going to keep repeating.
Yeah, you mentioned it. You mentioned a really good point. I wanted to bring up is you mentioned timeline. Based on your evidence, how long do you think it actually takes before you can reasonably conclude that an acquisition is either a success or a failure? You mentioned it, extending out comp plans and things like that till you have concrete evidence. Is there a kind of rule of thumb thing to say, look, you're not going to be able to figure this out for probably 3 to 5 years?
Yeah.
I don't know if that's a reasonable timeline. Do you have a timeline in mind in terms of when it's clear that the acquisition is either going to be a success or a failure?
Well, yeah, go ahead, Baruch.
I would say it's much shorter. If you don't see a clear path to success in 2-3 years, the probability of success later is extremely low in this case. You have to see some relatively quick 2-3 years evidence of additional subscribers, of decreases in production costs, of new markets that were open. If you don't see any of them, and it just goes on and on and on, it's probably going to be a miserable failure.
Yeah, I agree. From our data, we also saw the same pattern. If the initial phase of acquisition is not successful, extending the time horizon really doesn't make too much difference. Instead, many executives have this false hope that, okay, maybe I haven't tried hard enough. I'm gonna, keep it longer, and hopefully someday things will turn around. As Brooke just mentioned, the longer you keep a failed acquisition, the larger your final loss is going to be, which unfortunately is a very common mentality among executives involved in acquisitions.
And do you see any pattern of, the other issue you have is that, perhaps a new executive comes in and just says, we're done with it. We're writing this thing off, and we're going to, we're going to move on, and get it off the books. Do you have any, did your research indicate any of those, timelines, that even when you switch perhaps the executive team, that a new executive would come in and just kind of cut the cord and almost exit too early?
It is a common pattern, although in our book, we didn't look at that part. Instead, we focus on what a new CEO would do in the M&A decision. And we actually saw a pattern showing that many new CEOs coming to their new job with a plan to do a big acquisition. So the frequency of new CEO doing acquisition is usually higher than the frequency of other CEO, and the size of the acquisition is also larger. However, the success rate of new CEOs making acquisitions during the first couple years of their tenure is remarkably lower than the average success rate. So in this case, a new CEO coming to a new job with this idea, I'm going to change everything. I'm going to start with a big acquisition. Usually it's a recipe for failure.
Got it. So Baruch, the next thing I want to just touch on was how to pay for an acquisition. So let's say you're a board member out there, a new company you're thinking about acquiring, and you got to make a call. Is it cash or debt, or cash or equity in terms of how I'm going to pay for my my acquisition? Both of them are going to have positives and negatives. What's the research yield? Is there a preferred way to pay for the acquisition? Either call it cash/debt or equity. Is there a good or a bad way to pay for the acquisition?
Usually the consideration is how confident are our managers in the success of the acquisition. If they are very confident in the success of the acquisitions, then paying cash is the best way of doing it, because you don't spread your ownership. Basically, your current set of owners will get all the benefits of the acquisitions. If you are less certain about that, then the benefits of equity comes in. You basically give new equity, and you spread the risk of the acquisition among many more shareholders than before. So managers' assessment of the success of the acquisition will determine in most cases whether it's cash in case of very high success expectation, or a combination of cash or equity in case of no certainty about the success of the acquisition.
And presumably there has been a fair number of companies that, the risk of, paying too much cash, and let's say by extension, paying too much debt, is you're creating an interest obligation and a principal obligation in the future that contractually has to be repaid. And if that acquisition then is combined with the fact that there's a high risk of failure and those cash flows aren't there, you may just spell the end of the company, the consolidated company, at some point if it's not done properly. Is that fair?
Yeah. We had one of our variables in the model is the increase in the level of debt of the acquiring company post-acquisition. So they don't have cash, they have to borrow, they increase debt. One of the examples we give is a huge acquisition by the largest generic drug manufacturer, Teva, which happens to be an Israeli company. And they increased their debt like by $40 billion. This almost destroyed the company. Because on one end, you have an acquisition with a very iffy success rate, On the other hand, you have a debt without IFI at all. You have to pay the debt and the interest on time. You get yourself into a terrible situation if you finance acquisition mostly by debt. We have seen many such cases.
Yeah, well, even if you can service the interest payment, if you go offside on a covenant on any particular quarter or month or however frequent your covenants are, that could be just as problematic as not paying your interest or principal. You screw the company just by going offside in your covenant on a
Yeah,
particular
yeah.
quarter.
Yeah, yeah,
Um,
yeah. You're absolutely right. Borrowing too much long-term debt to finance acquisition is another detrimental factor for the success and failure of acquisition. We empirically verify this very important relationship using our data. As Baruch just mentioned, a large increase in the level of long-term debt associated with acquisition contributes significantly to the failure rate of acquisition.
got it.
I just want to tie it very briefly to what Feng said before. Our quite surprising finding that acquiring companies, on average, of course, acquiring companies decreased profit. They had a lower profitability over time. The profitability decreases from year to year. Or so you have your companies with low profitability, meaning their equity, their shares are not very appealing, not to investors, and definitely not to the owners of the target, who are supposed to get these so-called rotten shares. Usually these companies don't have lots of money, so they are forced to borrow a lot. They are forced to borrow a lot to make this saving acquisition. And this is a recipe for failure.
Feng, I'm going to send this question over to you. We talked about the lowering success rate of acquisitions over time, and you say, well, why haven't we learned? Now, there's a discussion in your book about accounting, and about 10 years ago, you wrote another book. Both of you wrote another book, basically saying accounting is dead, and that we need to change as an industry. Do you think one of the reasons why acquisitions have become less successful is because, maybe the accounting just hasn't kept up with some of the changes in the industry, that it's a lot harder maybe to evaluate the immediate benefits of an acquisition, because again, the nature of what's being acquired, again, you guys outline it perfectly in your book, book value, net earnings, the concept of fixed assets. When you go back to the 70s, those were maybe a lot more relevant than where we are today, where a huge percentage of the assets are intangible assets. And I'm
Right.
not even really talking about goodwill. But do you think part of the issue is that the accounting just has not kept up with the industry over the past 50 or 60 years?
Yeah, we agree. Accounting certainly plays a role here because when you look at what happens on the accounting side after acquisition is closed, you get a couple of new accounts. All of a sudden, they appear on the balance sheet and all the financial statement as a acquiring company. Goodwill is one of them. We already talked about the problematic nature of goodwill. So over the last 10 to 15 years, we have seen a trend, which we document in our book, that a bunch of acquisition-related intangibles have become a much more important part of the overall acquisition price. So in other words, acquiring companies are paying more and more for these hard to value, hard to verify assets. Collectively, they're termed acquisition-related intangibles on the balance sheet of the acquiring company. So things like acquired technologies, acquired customer list, acquired contracts, and so on. It's not because intangibles are not valuable. No, we have been a long-term advocate for the importance and value creation of intangible assets. But in this setting of mergers acquisition, a lot of things can go wrong because accounting is not always transparent, and what is being recognized on the balance sheet in order to fit this accounting model. Okay, I got this acquisition price. I have to allocate it among different assets. Whatever is not, related to physical assets has to go to either goodwill or acquisition-related intangibles. But for goodwill, I know I got a problem there because I have to face this goodwill impairment test every year. And if I have too much in goodwill, then I'm going to increase my impairment risk down the road, which is really embarrassing because all of a sudden, if I announce a large goodwill impairment, it basically tells us everything has failed for this acquisition. On the other hand, if I can, increase my acquisition-related intangibles, this would help me minimize my goodwill impairment risk because these acquisition-related intangibles can be amortized over time. So that provides me with some protection. I can even select a very aggressive amortization schedule. So even in the year of acquisition, as soon as the deal is closed, I can amortize up to 10%, 15% of acquired intangibles. So this sort of flexibility for managers certainly make the whole accounting signal from mergers acquisition to be not very useful. In fact, we document in our book that the higher a company pays for goodwill and acquisition related intangibles, the lower is the chance of M&A success.
And do you think, Feng, that's because goodwill is typically going to capture synergies? And because, generally speaking, what we're saying is that the synergies might not come to fruition, is that might be an indicator that if you have too much goodwill on the balance sheet, there's a high probability that a large chunk of that purchase price is dependent on synergies,
Yeah.
and not perhaps a customer list or underlying, intellectual property or whatever it may be. But if it's really based on synergies, that may indicate that that acquisition is ultimately going to fail.
Yeah, that's certainly the case. As I mentioned, this earlier paper Baruch and I published more than 10 years ago. We demonstrate this, relationship between high amount of goodwill and high amount of goodwill impairment down the road. So if you have a lot of goodwill included in your acquisition price, it basically means you have very high expectations for synergies to be realized, and we all understand the high risk of this type of expectations. If synergy is not realized because of integration issues or because of the initial failure to identify a proper target, then you substantially increase the risk of goodwill impairment.
Got it.
That's
And-
just a minor point here. Goodwill should reflect synergies, but in many cases, goodwill just reflects overpayment, mistakes by the acquirer in valuing the company. After all, valuation of companies is incredibly difficult. It's more an art than science. And overpayment must be rampant in this case. And any overpayment for a company will be reflected in the goodwill.
Yeah.
100%.
Good
It's the
point.
unallocated purchase price. That's really, even if you look at the definition of goodwill, it may include certain things, but at the end of the day, it's the element of the purchase price that is unallocated to tangible, or intangible assets. It is the plug to some degree, right?
Got the
So,
residual number. Yeah, you're absolutely right. Yeah, Baruch made an excellent point about this connection between goodwill and overpayment. A large part of goodwill does reflect overpayment.
yeah.
In any case of contested acquisitions, meaning several companies, like in YouTube, several companies at the time, 5 companies decided to buy and wanted to buy YouTube. Finally, Google made it. But in any case of a contested acquisition, you are likely to get what's called in the gambling language, the winner's curse.
Yeah, winner's curse.
Those who will provide the highest purchase, those who offer the highest purchase price, which probably includes the highest mistake in assessing the value of the acquisition, they get it. And you get it, and it's a curse. There's a beautiful study that was done on contested acquisitions where they compared the consequences of those who won the contest with those who failed the contest. And turned out that over 3 to 5 years, those who failed to acquire did much better than essentially won the contest. Feng, what's the name of this paper? It has a great name.
Yeah, thank you for bringing out, Baruch. The title of this paper is Winning by Losing.
It's a beautiful paper. Winning by losing.
Wow.
Look, it makes sense. You want to win at the casino, don't go in the casino.
Yeah.
Exactly. Baruch, the other thing maybe to touch on with respect to the accounting, and you guys really dig into this in a lot more detail in your first book, but you also touch upon it in your second book, is this issue amongst accountants where we don't really do a great job of capturing internally generated assets. So if we go out and buy an asset, we can put that on the books. Let's say we pay $1 million for software. We can put that $1 million for software on the books, provided we're sending that payment to a third party and we're acquiring a business or some sort of asset in return. However, if we choose to try to develop that software internally, for the most part, it just gets expensed as incurred. And you have this significant disconnect now between these two options, which frankly are very similar. Like from an economic perspective, those two paths that you can go down are very economically similar. However, from an accounting perspective, you get two drastically different outcomes. One where you expense everything and one where you capitalize everything. And you do a great job in your book of really getting into this and what it means from an M&A perspective in terms of, do I go out and acquire a company and acquire those resources or that asset, or do I develop them internally? Maybe just give us some perspective on that difference from an accounting perspective and how that played into the analysis in M&A.
Well, the accounting is very clear that, as you very well demonstrated, argued, that if you acquire particularly intangibles, then they will appear on the balance sheet. It's considered as an investment. But if you, as most companies, develop it internally, that's what research and development is doing, then it's regarded as a regular expense, like salaries, like rent, like insurance and others. This is complete lunacy. First of all, aside from mergers and acquisitions, it completely destroyed the income statement.
Yeah.
Because the income statement is based, and that's when I taught accounting, this was in my first class of accounting. The income statement is based on careful matching of revenues with the expenses that were incurred in generating those revenues. Now, if you expense research and development and put them in the income statement of the company, then they are not matched with current revenues. They will be matched with future revenues when products will come out of this research and development. So that's a complete misalignment. And practically all studies have shown that net income earnings is by now a meaningless figure, which of course goes back to one of your previous questions. That's also burdens acquirers. Don't have on the balance sheet of the target company some kind of an asset. There are many acquisitions of research capacity, particularly by pharmaceutical companies, by chemical companies. They acquire another company not for buildings, not for chairs. They're acquiring for a laboratory, a research capacity. And the whole value of this research capacity is not on the balance sheet. It's expensed every year. It disappears in the next year. And it makes life very difficult for acquiring company to put somehow a value of what's the value of a lab of 600 people who are developing drugs now. Nowhere is it reflected in the accounting accounting statements. They grow year by year. Some annual reports now get to the length of 200 pages, 250 pages. full with numbers. Most information is completely redundant. Has no value for making decisions. As long as the basic accounting is so flawed. You yourself said, and you're basically dealing with the same thing: acquiring an intangible or generating an intangible, self-generating an intangible. How can the accounting be so different? Many years ago, when I was still favored by the Financial Accounting Standards Board, this is the body that decides about accounting standards in the United States, they invited me for a whole day to speak about intangibles. And I told them, how can you allow such an inconsistency in the financial report? So one of them said, this is not inconsistency. If you acquire it, it's a transaction with a third company. And I said, if you develop it and you pay salaries of 75% about of the R&D is researchers' salary. You pay salaries of the recession. Is this not a third company, a third party transaction? They will not accept salary below what they think they are worth in this case. Exactly the same thing. Just the taker of the money is different.
Oh, yeah.
So they poo-pooed me and different is different. So I gave up on that. But financial reports are really of no use, or very little use, except for the revenues. The revenues are very little use for buyers.
Yeah, well, look, Baruch, I heard you on a podcast, and I've told this story to a few others. You shared this story. I think it was one of the oil companies where you pulled their income statement from the 1930s, and you compared it to their income statement at some point in the 2000s, and said these income statements are identical. There's no changes. How many industries out there where you could pull something from the 1930s would be identical to something in the year 2010? It's almost impossible. So why should that be the case in accounting?
Yeah.
It's even worse than that. I had in my hand the first financial report of U.S. Steel from 1902, almost 125 years ago.
Yeah.
And I took this, I added to it a financial report of a company, I forgot, another steel company currently. I sent it to the FASB and I said, please point to me the improvements that were made over the last 125 years in accounting, because the one from 1902 was a very good financial report. It had everything in it. It had a balance sheet, an income statement, cash flow statement, and others. I got some nasty responses from them, but there is not much improvement in accounting.
I think it would be interesting to see as well as that if you compared book value to market cap and you looked at those differences over time, I think what you would find is that the difference between book value versus market cap, especially on successful companies, that gap has probably widened tremendously over the past 30 years. And it's partially because, again, you have this disconnect where all of these expenses, which clearly have future economic benefit, like expending on research and development, are being expensed. Whereas in reality, the market is looking at those and saying, no, those clearly have future benefit. And then you have this huge gap between what the company is actually worth on the market versus what the book value is of that company. And if there's a huge gap between those two, it certainly raises the question of saying, well, how useful is this set of financials at the end of the day?
Yeah. You're absolutely right. Baruch mentioned how this accounting is destroying the income statement. We recently published a study where we focus on the income statement side of this whole distortion. We look at the percentage of companies reporting losses from their continuing operation. As you can imagine, this percentage has been going up persistently over time. So when we ended our sample, it was 2019, shortly before COVID. about 46% of all U.S. publicly traded companies were reporting losses. If you recall, that was a year with very strong economic growth and overall very good performance in our economy, and yet close to 50% of our publicly traded companies were reporting losses. Accounting is completely detached from economic reality. And then if you look at the tech sector, one of the most booming part of our economy, that percentage of loss reporting was even higher, 70%. So even for people who don't understand the ins and outs of accounting, if they have some very basic background about what profit means, they will realize this doesn't make any sense. You cannot have the majority of a companies reporting losses, otherwise very strong and a robust economy.
Absolutely. And you guys talked a little bit about this as well, about Amazon, is that if you really look back at Amazon during those earlier days, they were generating losses. But if you look through it on what they were actually doing, the losses completely, completely misrepresented the value of the underlying company. Sorry, Baruch, go ahead. I didn't mean to cut you off. Sorry.
No, that's exactly what I wanted to say. I have a friend who teaches finance at Columbia. And he told me that he starts every class by saying, who would invest in the company that reported 15 years of losses? He says some students look around if they are in the right room. Some students look at him if they chose the right instructor in this case. I mean, of course, no one. They said if you invested in Amazon and similarly to it, Tesla, you wouldn't sit today in the class. You would be in the French Riviera in a yacht.
Absolutely. That's a great example. Absolutely. Obviously it's hard to find those companies, but again, I would encourage people who are listening to this, let's check out two things. Number one, Baruch and Feng, in your book, you go through a whole bunch of a checklist, which basically an M&A checklist, which again, if you're listening to this, I would highly encourage you to pick up their book. And if you read nothing else, read the checklist, because that'll at least equip you with some data, some back data to help you with acquisitions. And the other thing too, that in your first book on, the accounting is dead, this concept of a value scorecard. It's a very interesting idea, and I very, almost as a replacement to maybe or maybe a supplement to what what we have from an accounting perspective. Take a look at that, because again, you go through about 4 or 5 different industries where you pick a company and put together a value scorecard, and why that's actually more relevant than an income statement. And did that ever get any pickup, guys? Did anybody look at that and say, good idea, and try to replicate what you guys had put together 10 years ago?
They don't tell us. They don't tell us. I'm sure that people are doing it. I'm sure that consultants try to do it. We didn't hear about that, but thank you for mentioning it. We think it's a very important part of our book. It's clearly unique. I haven't seen such it's basically a prediction model of the likelihood of the success of an acquisition. I haven't seen it in any study, either academic or by consultants, by managers. And we just give you 10 variables that are easy to find in the financial reports. And from those 10 variables, you get a prediction if the acquisition will be successful or not.
Yeah. I thought it was terrific. And again, I think you still read on the front page of the newspaper earnings per share as the lead, but like you say, man, oh man, that is net income is not what it used to be. That's for sure. Guys, last question. What's the next book? Is there another accounting topic or M&A topic that you're going to address in your next book? Or is it, do you have what's the next project in the pipeline?
I mean, books like the two that you mentioned are take about 3 years to write.
Yeah.
I mean, that's an incredible investment.
Yeah.
I'm not a youngster. I'm not sure I want to spend the next 3 years on a book, but if a good project will come up, sure, why not?
Yeah, absolutely. Yeah. So on this M&A topic, we have been thinking about some follow-up work. For example, looking at the financial reporting side. Now we have realized accounting is not perfect; it's deeply flawed. When it comes to informing investors of what risk MA may have, what may be the fallout, what may give us some pre-warning signal about the failure of M&A. Let's find out what else can be done to help investors better understand the prospects of MA based on the current information system. So that's something we're very interested. It's basically a follow-up of some of the discoveries we made in the book. How do we help investors understand this better?
Well, I know there's a lot of analysts up north of the border here who I know who really believe. I don't know if you guys probably have something similar in the U.S. of a business acquisition report, referred to as a bar up here north of the border, where anytime there's a material acquisition, you got to go through and you got to put together pro forma disclosures and all this other sort of stuff, and how the acquisition's going to look and things. And a lot of the folks north of the border really believe that there should be more of those bars, those business acquisition reports, and less of those, and more disclosures like that might help predict the future, as opposed to less of it. But guys, thank you very much for joining us today. Really appreciate you taking the time. For anybody listening, again, if you have an interest in business or finance, I would highly recommend you take a read of their books. They're really, really good, with some really good information towards the end, which is really simplified to help people make good decisions. But guys, thank you very much for taking the time. We really appreciate it.
Thank you, and we enjoyed it.
Great.
Thank you for having us.